All right, good morning and good afternoon if you're where I am in New Jersey. Good morning to you, Joe, and all the attendees here. I want to thank you for attending Next Generation Trust Services presentation with Joe Luby from Jagen Funds. We want to thank him for presenting along with us. He is going to be presenting about tax strategies for IRAs and Roth conversions, which I know a number of our clients are very interested in hearing about, as well as many prospects always discuss Roth accounts and tax-free earnings, which we love. My name is Jared Lopez. I'm with Next Generation Trust Services. We do self-directed retirement plans. My part of the presentation will be 10 to 15 minutes. We're going to be discussing self-directed retirement plans and who we are and what we do. If you have any questions during the presentation, you can chat them in. Usually I like to take any questions as I'm going along with my presentation, or you could save them till the very end. The easiest way to discuss self-directed IRAs and the easiest way to present it is, who are we? We're Next Generation Trust Services, as I said. We are a third-party administrator for self-directed IRAs. Now, what is a self-directed IRA? Now, normally with an IRA, you can invest in stocks, bonds, mutual funds, CDs, things like that. Now, with a self-directed IRA and using a self-directed administrator and custodian, you're allowed to open up your investments. You're allowed to invest in practically anything. There are a few restrictions that go along with that, and we'll discuss that a little later. When you invest in an asset using your retirement funds, you need an administrator and a custodian. What Next Generation Trust Services does, we do the record keeping and the IRS reporting for your IRA. Next Generation Trust Services is not a bank or a depository. No funds are held here. We have our custodian bank where the funds are held. We are also not a financial planning service. People call up all the time. I actually got a call up about an hour ago. Hey, Jared, what's the better investment, gold or silver? What's the best real estate market? Where should I be buying? Unfortunately, we can't help you with questions like that. We can never, ever endorse or recommend anything. The plan is completely self-directed and is completely up to you. With that, we ask that you do your research on the potential investment. All we can do at Next Generation is provide education on what you can and cannot do within a retirement plan. And we give a yes or no as to what's allowable. We make it known that even if you're recommended to Next Generation Trust Services by another company or through another party, we're not affiliated with them at all. Now, I'm going to briefly describe the plans that can be self-directed. Basically, any type of IRA can be self-directed. The traditional, the Roth, as I'm sure Joe is going to go into extensively later. The SEP IRA, which is for self-employed individuals. The Simple IRA, which is for small businesses. The 401k plans can be self-directed if you're set up properly. And also some specialty plans, including the Coverdell, which is for education purposes, and the health savings account. Now, if you have any questions on any of these documents and how they can be self-directed, you can always give the office a call. I'd be glad to talk with anyone. In the interest of saving time, I'm going to go through funding an account fairly quickly as well. There are 4 ways to fund an account. The first one is a contribution for the tax year. The traditional and Roth accounts can have a contribution of $5,000 each tax year, and if you're over the age of 50 years old, you can add an extra $1,000 to that. So that's $6,000 that you can contribute to your IRA once you're over the age of 50. Also, with the self-employed plan, the contribution limit is 25% of your income up to $49,000. So it's the lower value of 25% of your income up to $49,000 can be made as a contribution into your IRA account. Another option to fund your account is a transfer. That's moving funds between like accounts. So if you have a traditional IRA with your custodian and you're doing stocks and bonds, you can transfer those funds into an IRA with us, and it would stay tax deferred or tax free depending on which account you have and which account you're opening with us. A rollover is moving funds between unlike plans. The most frequent example we see of that is someone who has an old 401k from an old employer, and they roll that over into a traditional IRA with us. It's between unlike plans because it used to be a 401k. Now it's a traditional account which they can self-direct with us. The other option, as I'm sure Joe is going to be talking a lot about, is a conversion. So I'm just going to leave that up to him to speak about later. There are certain restrictions that go along with a self-directed IRA. There are two types of restrictions. The first one is prohibited transactions. There are two things that you cannot invest in. That's life insurance and collectibles, and that's it. For collectibles, no wines, no stamps, no art, or my personal favorite, baseball cards. You cannot invest in those types of assets. There are several clients of ours who invest in a company, and that company invests in wine. They trade and they sell wine. They do not. The clients of ours do not physically hold the wine in their retirement plan, but they invest in a company that does. On our books, it's a completely allowable investment, and the clients are happy because they see it as sort of a way to get around the limitation. But it's not, because they're investing in the company itself. The other restriction is disqualified persons. These are people who cannot have any interaction or personal gains from your IRA's current assets. These people are the IRA holder, their spouse, any ascendants, any descendants, and their spouses cannot have any interaction or personal gains from your IRA. So what does that mean? Basically, if you hold a piece of real estate in your retirement plan and are looking to have construction done on the property, your father's contracting company cannot do the work. If and when we do find out that happens, your account would need to be distributed with taxes and penalties, and we don't like to hear that. We've actually heard of somebody who was penalized with taxes up to 150% of their account value. So it's very serious. These people should not have any interactions with your assets. Another problem we see is an IRA holder living in their home that the IRA owns, or their children renting out an apartment that is owned by your IRA. Again, that is not allowed, and if we do hear of that or find out about that, it would need to be distributed. So this is very serious. You should not have any dealings with disqualified persons. However, you need to make note that horizontally on the family line are allowed to have dealings with your assets. So brothers, sisters, cousins, they could potentially rent out the apartment at fair market value. They are not disqualified. So that's the sad part. That's the restrictions. Let's talk about possible investments. Now, possible investments include everything else: real estate, loans, notes, partnerships, LLCs, tax liens, precious metals. The list goes on and on. I'll give you an example of some of our favorites around the office. A woman recently purchased a contract for mahogany trees in Costa Rica. Basically, she purchased a contract and the seeds to these trees. And in 15 years, when the trees are fully grown and sold and cut up and made into our furniture, Uh, that's how her IRA would get paid. All the funds coming from the sale of that tree would come into her IRA. So again, we'll see in 15 years what sort of return she gets. One client wanted to invest in personal seat licenses for the football team, the New York Jets, with his retirement plan. He would not be able to use the seat, however, it is an allowable investment. Any funds he receives from the sale of the tickets would have to go into his retirement plan. But again, he would not be able to sit in the seats for any of the games. He wouldn't even be able to purchase the tickets himself because he is disqualified. It was perfectly fine with this prospect because he was a Bills fan. So he did not want to go see the Jets. He hated the Jets. But unfortunately, he didn't take that route because that's very unfortunate because we would have loved to see how that worked out. He did not decide to go in to pursue that venture, but we did find out it's an allowable investment. That's us doing our homework to see what's allowable and what's not allowable. Now, again, I want to reiterate that up and down the family line is strictly prohibited from any investment, but horizontally, brothers, sisters, cousins are not considered disqualified. Any service provided by the IRA would need to be paid out by the IRA. No service can be provided by a disqualified person, and any funds that are going in and out of the IRA-owned asset just needs to be that, in and out of the IRA itself. So we'll give an example from the beginning to the end on how setting up an account as well as having a transaction works with us. Actually, first is not listed as number one there. I'm gonna add one. Open and fund an account with at least enough for a good faith deposit. Starts the real estate example. When you do have an account and establish an account with us that is funded, you can go and you can locate an investment property how you would normally outside of your IRA. The only difference is when you find that property and you're negotiating the purchase contract, the contract would actually be listed in the name of your retirement plan. So the name of the retirement plan in our certain case is Next Generation TS, which is Next Generation Trust Services, for the benefit of John Smith, IRA number 123. That's actually going to be on the contract. That is the owner of the property. You submit that contract to Next Generation Trust with the deposit instructions. We will sign and execute the contract and submit the deposit. At that point, when it's under contract, you do your due diligence, which is a home inspection, title search, anything you normally would do. However, the IRA would need to pay for any of these services. You submit the approved closing documents with escrow instructions to Next Generation Trust. You hand us the closing documents, and that's it. You own this property. Now, if there are any questions, you can send them to me now, or I can take them at the end of Joe's presentation. My name, again, is Jared Lopez. You can contact me at the phone number there, which is 973-533-1880. And my email is Jared, which is spelled Jaredl, @nextgenerationtrust.com. I'm going to give about 30 seconds to see if there are any questions. Before I hand it off to Mr. Luby. Okay, I see one question that just came in. What are some downsides to investing with a self-directed IRA? Well, I wouldn't consider it a downside, but it's not a hands-off type of investment. You need to be savvy. You need to stay on top of your IRA investment when it's self-directed. Now, I know some people, including my family, they like the fact that you know, they invest in the stock market and it's hands off. Whatever happens, happens. You will not be able to do that with a self-directed IRA, especially if you purchase properties. So again, you just need to do your research on any investment and stay on top of it. Can my IRA, my self-directed IRA, make loans to other individuals who want to buy real estate? Yes, absolutely they can. That's one of the allowable investments that I'm going to go back to. They can absolutely make loans, unsecured or secured by properties. And the best part of that is that you guys get to agree on the terms. Well, if that's it, I'm going to hand it off to Mr. Joe Luby, who will be discussing again Roth conversions. And if you have any other questions about self-directed retirement plans, you can save them for the end. So thank you very much. And Mr. Luby, it is now yours.
Great, Jared. Thanks. Let me click on here. So if you just confirm, did that come up with the new slide?
Yes, it did. Yes, it did.
Okay, perfect. Okay, great. Well, we'll jump right into the meat of my topic, which is how to maximize a Roth conversion, and we'll talk about why you might even want to consider it to begin with, and then get into how do you make it more attractive. So the first thing is similar to what Jared had early in his presentation. We always have to have some kind of disclaimer that says this is general educational information. It's not specific to any person or their case, and you need to really have professional advisors look at your own scenario and advise you on a particular question that you may have on your account. But for general information purposes, these are the rules and concepts that may be beneficial to you to consider. So the first thing is, why a Roth IRA at all? If we're talking about doing a Roth conversion, which is the act of taking a traditional IRA, an existing traditional IRA, and converting it into a Roth, then the question is, why would we even consider that transaction? And the main thing is, number one, is that Roth IRAs are tax-free accounts as long as the distributions are qualified. And a qualified distribution is basically one that's from an account that's been in place for 5 years or more, and the account owner is over age 59 and a half. This is a sea change in the retirement plan marketplace in the United States. The Roth IRA, when it first came out in the late 90s, was the first time that there was an actual vehicle that produced tax-free results on essentially any investment that you might want to invest in, with very, very few limitations. Previously, to get a tax-free investment or tax-free treatment, you were pretty much looking at municipal bonds and things like that. So this gave the opportunity for tax-free treatment to all sorts of assets, including stocks and real estate and so forth. So it was a really unique and major opportunity in the retirement plan marketplace. And of course, now we've got the Roth 401k accounts as well. Another benefit to the Roth is that they get what's called first in and first out treatment on withdrawals. In other words, if I put $1 into a Roth IRA today as a contribution, I can turn around later on anytime and take that dollar out, regardless of any gains that I might have on that, and there's no tax consequences and no penalty. I can always take my contributions back out. Now that rule is a little bit different for Roth conversions, and we're not going to go into that in detail here, but just understand that there is a different rule applies to Roth conversion dollars that go in versus straight contributions that go in. There's also no required distributions from a Roth IRA. So folks that do not want to be forced to make taxable withdrawals from an IRA at age 70 and a half are better off with a Roth IRA in many cases, because they can leave the dollars in the tax-free environment indefinitely, and then it becomes as the last bullet point says, a better wealth transfer vehicle if that's really the main goal. A lot of times that is the case. We have clients get an IRA that they're not going to touch in their lifetime. They have enough other assets or income to sustain them, and they want to just leave that retirement account to their beneficiaries. A Roth IRA is a much better transfer vehicle for retirement dollars than a traditional IRA, because the beneficiary receives the funds on an income tax-free basis as well. And again, if if you do take money out, or if someone does take money out of Roth, it doesn't affect the tax bracket, so you don't get bumped up into a higher tax bracket that may affect Social Security, or if they ever implement means testing on Social Security, anything like that. You don't have to worry that a Roth distribution will affect the tax bill or the tax bracket. So another major reason to consider a conversion is that today's tax rates are lower than what tax rates are expected to be come January 1 next year. So, barring any action by Congress in the interim, we know for a fact that tax rates under current law will go up. They're going to increase January 1 of 2013. And just in general, if you ask almost anybody where they think, in the professional advisor community anyway, where they think tax rates are going to be in the next few years, invariably you're going to hear that they think that they're going to be higher. So if you have the opportunity to lock in a taxable event today at a lower rate, and then you never pay tax again on the growth in that account, then there's a tremendous opportunity to put the tax law into your favor as it currently stands. Now again, you can't predict the future, and who knows if Congress will change those rules between now and then, or change the rates between now and then, but in general, most people believe that at some point, whether it's January 1st next year or later, that rates down the road will be higher than we have today. Another interesting component of a Roth conversion is that it's one of the very few, if not the only, opportunity within the tax code to have a completely risk-free transaction, or engage in a completely risk-free transaction. In other words, there's absolutely no reason not to do a conversion because you get to change your mind. You get a do-over. It's, again, one of the few, if not the only, areas of the tax code where you can actually go back in and say, no, I don't really think so. I'm going to undo that, pretend like it never happened, and the tax code treats it as a no harm, no foul type scenario, and it's literally as though you never did the conversion. And here's the rule on how that works. If you do a conversion in whatever tax year it is, so we'll assume you do it this year in 2012, you have up until your tax filing deadline plus extensions, which is effectively October 15th, to undo that transaction. So in other words, if you're going to, when you go to file your tax return for 2012, you have up until October 15th of 2013 to actually do that filing. That's the filing deadline plus extension. Up until that date, you have the ability to undo a Roth conversion from 2012. And it's technically called a recharacterization. You're actually recharacterizing the transaction back into a traditional IRA. And again, it's no harm, no foul. It's as though nothing happened. It's literally as though the event never took place. After October 15th, you lose the ability to recharacterize that conversion. But you have, effectively, if you do it early in the year, you've got about 21 and a half months to sit around and think about that transaction and decide, was it a good idea, or should I leave it, or should I undo it? And that's just amazing, in terms of opportunity, because again, there's no reason for someone not to go ahead and do a Roth conversion now while the tax rates are what we have today, because you can wait and see. If tax rates don't go up, if the law has changed, and in 2013 the rates don't increase, and for some reason you want to undo the conversion and maybe redo it in 2013, maybe there's some other aspects to your tax situation to make that a better idea, you can do that. You can do the conversion today and lock in 2012, and if you decide in 2013 that it's not the best outcome for you, you undo it, and you can redo your conversion within certain parameters in 2013. So it's an amazing opportunity, and again, completely risk-free. There's no reason not to do the Roth conversion. And then analyze it later on. So we're going to look at the math involved, and then we're going to talk about how to solve the tax problem. So my slide got bumped here, it looks like, but you'll be able to follow along. So if you've got an IRA with $100,000 in it, and we do a Roth conversion, the big drawback to the conversion is that it's a taxable event. So assuming that all of the dollars inside the traditional IRA are pre-tax dollars, which most of the time they are. You put a contribution into the IRA and it's deductible, so it's pre-tax money that goes in. You've got $100,000 of pre-tax money, but when it goes into the Roth, it has to be taxed, because that's one of criteria on a Roth is that all the dollars going into the account have to have already been taxed as income. So that sort of buys you the right to never pay tax again on any of the growth. You pay tax on the principal that goes in, but you don't have to pay tax on any earnings down the road. So at the time of the conversion, all of that IRA value that has been sitting there and has not been taxed, it becomes taxable at the time of conversion. So in this scenario, we're just going to use a Fed tax rate of 28%, and we're going to tack on 5% state tax. This is hypothetical. It's not, state taxes all over the board. Here in Nevada, it's 0. California, our next door neighbor, it's about 10%. So, it ranges quite a ways. And so, for our purposes, it comes to a total of 33%, roughly a third of the account value subject to tax. And, on average, that's probably a pretty good estimate around the country. So the problem with that is that people look at that 33,000 and go, well, I don't want to pay 33,000 in tax. Even if the conversion sounds like a good idea, writing a check to Uncle Sam for 33,000 usually doesn't sound like a good idea. And the other component to this is ideally you want to pay that tax bill out of other dollars. You don't want to tap into the IRA for money to pay the tax bill, because then you've sort of defeated the purpose of moving dollars into the tax-free environment to begin with. The whole point of getting them in there is so that you've got a large tax-free account earning, tax-free earnings. You don't want to erode that by pulling a third of it out to pay the tax man. So ideally, you want those dollars to come from somewhere else. Another problem with taking the money out of the IRA is that it becomes subject to penalty if you're under 59.5. So there's not an exception. There's no exception in the rule that says, okay, if you're paying Roth conversion tax, we'll let you off the hook for the penalty. You still have to pay that 10% penalty as well if you're under 59.5. So again, it's best to pay the tax bill with non-IRA dollars from somewhere else. Again, that can cause an issue because people look at that and say, well, where do I want to pull that from? Or I don't want to pull that from other investments or other assets and so forth. So now let's talk about how we can address some of these issues and make the entire transaction more palatable and more attractive. So the first strategy is, and we're going to talk about two main strategies. The second one being the more powerful. I'll just sort of tease you up front and let you know that the second strategy I'm going to talk about is the more powerful of the two. But the first one is important to know, and it's called the IRA segregation strategy. And essentially this is where you take the existing IRA and break it up into multiple smaller IRAs based on asset class. So in other words, in this example, we've got ABC fund, XYZ fund, and M&O fund. And fund is a very generic term. I'm not referring to mutual funds specifically or, any type of investment. It could be a limited partnership. It could be a REIT. It could be a business development corporation. It could be partial ownership in a real estate project. So don't get hung up on the fund as meaning a mutual fund or something like that, because that's not how it's intended. So if you take the three, now you've broken up the bigger IRA into three smaller IRAs, and the goal here is to make sure that the assets in each IRA are substantially different in terms of asset class. In other words, number one might be a real estate holding. Number two might be a precious metals IRA. Number three might be some type of private company stock that the IRA is invested in, something like that. But in general, what we're looking at is different asset classes that theoretically will move differently, depending on economic circumstances. And then what the next step is, to convert each of those IRAs into its own separate Roth IRA. So now we've got Roth IRA 1, 2, and 3. We still own the exact same asset that we had before. It's just now we're in the Roth environment with each of these three accounts. Now, you have to sort of weigh the benefit of this strategy, and I'll show you the benefit in the next slide, but you have to weigh the benefit of this strategy against the cost and administrative hassle to break this up into multiple accounts, and maybe there's multiple account fees and things like that. So you have to sort of consider both sides of it. But if the IRA is large enough, or even if there's just one particular asset that you want to segregate out, then this is pretty much a no-brainer. You need to do it before you do your Roth conversion, and here's why. At the end of the recharacterization timeline, in other words, up to that October 15th deadline, you're going to be looking at the assets in these Roth IRAs to see how they've performed. Because as you remember, when we did the conversion from a slide ago, the value at the time of the conversion was $100,000 on each of these assets. So if we're looking at this, and let's say it's September, right before the October deadline is about to hit, it's September, and we're looking at this trying to decide, did we make a good decision in converting to a Roth? We're going to look at IRA number one, and we're going to say, well, that was a great decision. This IRA was up to $150,000, and we converted it when it was worth $100, and so we're paying tax at $100,000, level on an asset that's now worth $150,000. That was a good deal. Let's leave it alone. Number two, same thing. It's at $125,000. That was a good deal. We're still only paying tax at the $100,000 level. Leave that one alone. But IRA number three has tanked. We're down by half, so it's worth $50,000. So it doesn't make sense to pay tax on $100,000 of value or on an asset that's now worth $50,000 when we don't have to. And that's the benefit of the recharacterization opportunity, is that now you would go in and undo or recharacterize Roth IRA number three and leave the other two alone. Now, the reason you have to break, and again, it's as though it never happened, so you don't have to pay tax on $100,000. The reason you have to break up the IRA initially to get this, or to have this opportunity, is that the rules do not allow you to reach into one large IRA and cherry pick the assets that did poorly and only recharacterize those assets that are down in value. You have to. You can do a partial recharacterization. You could do, if you had a $300,000 IRA that you converted and you only want to recharacterize $100,000 of it, you can do that. But the way the rules work is that they allocate it as though you're reconverting a little bit of all of the assets. So you can't go in and cherry pick the losers. So you have to break it out like this, and then you can select the losers and go, okay, we're going to recharacterize these and leave the other ones alone. Now, when you want to, the benefit here also is that once you've got a Roth IRA number three recharacterized back to a traditional IRA, you can then reconvert back into a Roth at this new, lower valuation. And so you're going to, incur tax at the lower value, and it also, you get to have the same type of recharacterization opportunity again. So in other words, you start a new clock ticking until April 15th of the tax filing deadline for that year when you do the reconversion. The rule on that is if you want to do a reconversion after you've recharacterized a prior Roth conversion, is you have to wait the later of 30 days from the time of recharacterization or until the next tax year. So in other words, if you did the initial conversion in 2012, and then you did the recharacterization sometime next year in 2013. Let's say you reconverted today, and then you recharacterize next April, for example. You would already be in the new tax year, so you would have met that criteria, so you'd have to wait 30 days. And then you could do a reconversion at that lower value. So it's a great strategy. Again, if you're going to do a conversion on an account of any significant size, provided there are multiple asset classes in the account, you definitely want to break it up and buy yourself, put it that way, buy yourself this right or this opportunity to cherry pick the losers if there are any. Okay, so the more powerful technique is the one we're going to get into now, and that really brings hinges on the question of what is the asset inside the IRA really worth, because this is what determines the tax reporting value of the Roth conversion. So, the question is, what is in there? Is it private investments, private investment funds, limited partnership interests, real estate, tenant common deals, meaning partial ownership of real estate, private company stock, all the types of things that Next Generation Trust, would be the typical self-directed IRA on. You want to use their services for these types of assets. So what does the IRA own? That's the first question. The second question is, what is it worth? And we have to look at two different definitions of value to understand why this is important and what it does for the IRA owner. There's two major definitions of value. There's actually several others, believe it or not, but the two main ones that we're dealing with and concerned with are net asset value and fair market value. And net asset value is the one that you're probably most familiar with, even if you didn't know that was what the term was. Net asset value is basically the book value of a particular portfolio or fund, or you take the total amount of underlying assets in a given partnership or LLC or fund or whatever it is. You take the total value of all those underlying assets and divide it by the number of shares or units or interests that are outstanding of the overall parent fund. And that's net asset value. You can almost think of it like if we had a fund that had $1,000 total in it, total assets, and there were 100 shares owned by investors, then $1,000 divided by the 100 means that every share is worth $10. That's net asset value. If we cashed everything out tomorrow and paid everybody their full underlying value, they'd get $10 a share. Fair market value is an entirely different definition, and the importance of it is that it's the definition required for tax reporting purposes. So it becomes very important. Fair market value is, in the tax community, is actually known as the willing buyer, willing seller rule. It's so common that pretty much any tax planner worth his salt or her salt can recite this definition almost in their sleep. And it's paraphrased here, but I'll give you the more broad or the more complete definition on the audio. Fair market value is the price at which a property or an asset of whatever type would change hands between a willing buyer and a willing seller, neither being compelled to act and both being aware of all the relevant restrictions and facts and circumstances and so forth. So it's essentially what would two people agree to for a price in a true arm's length third-party type transaction. So a true hypothetical buyer and a hypothetical seller. And I'll give you an example that you can kind of follow through. Let's assume that I own a 25% interest in a partnership, and the partnership runs a string of dry cleaners. And another person owns the other 75%. So I'm a minority interest holder. I don't have a controlling vote. I can't force any type of liquidation of the company. I can't force a distribution or dividend payment. Now, let's say that on paper, the total value of all the assets are $1 million. There's $1 million worth of equipment and so forth. If we cashed everything out, sold it today, and distributed the cash, I would get $250,000, and the other partner would get $750,000. So now let's say I want to sell my interest. I want to sell my 25% interest in this partnership. And I go out to the marketplace and try to find a buyer. First of all, I got to find a buyer. That's difficult in and of itself because it doesn't, the interest of this partnership don't trade on an exchange somewhere where there's a readily available group of buyers waiting to buy my shares or buy my interest. So I've got to find a buyer, and then I have to entice the buyer to purchase my minority interest in this partnership, where they're going to step into my shoes and they're not going to be able to control any votes. They're not going to be able to force a distribution. They're not going to be able to control the direction of the company and so forth. So is it very likely that they're going to give me $250,000 even though that's the underlying net asset value of my interest? Probably not. We're going to negotiate some type of a discount or a price where they're going to demand a discount for the fact that they're buying an illiquid asset, and I'm going to have to accept that if we're ever going to get a deal done. So maybe we agree on $180,000, for example. Well, we've just set the fair market value at $180,000, while the net asset value was $250,000, or still is $250,000. So that gives you an idea of the difference between net asset value and fair market value. Fair market value takes into account all those other factors, such as how liquid is the asset, is it easy to convert it back to cash, all those types of things that net asset value doesn't concern itself with. A great example of how to understand these concepts in the public, sort of public securities, publicly traded marketplace is the closed-end fund market. Closed-end funds are mutual funds that there's only a certain number of shares outstanding of the fund, and those shares trade on the exchange all day long just like a stock. So the share price of a closed-end fund, what you can buy it for or sell it for at any given moment of the day will fluctuate, all day long, just like a stock price will. But the underlying assets of the fund are calculated daily at their net asset value. In other words, all of the investment portfolio of the closed-end fund is tallied up at the end of the trading day, and then they divide it by the number of shares of the closed-end fund that are held by investors, and that gives you the net asset value. But it's very rare that the net asset value is equal to the trading price at any given point in time during the day. And the trading price is the fair market value, because that's what willing buyers and willing sellers are actually agreeing to at any given moment during the trading day. And in fact, in the closed-end fund market, or in closed-end fund world, there's terminology specifically to tell you how it's trading. In fact, when the trading price is less than net asset value, so again, fair market value is less than the net asset value, the shares are said to be trading at a discount. And when the trading price is higher than net asset value, so again, fair market value, trading price, is higher than the net asset value, the shares are said to be trading at a premium. So there's actually terminology, and you can actually look up, on any given closed-end fund, whether it's trading at a discount or a premium at any given time. So that's a sort of a mainstream type investment product that has, easy to determine difference between net asset value and fair market value, and hopefully that helps you understand the fact that a specific asset can actually have two different values at the same time, even though it may sound odd. So this is important because, as I mentioned earlier, fair market value is the price or the value required when you're reporting the value of an asset for tax purposes. So if fair market value is different than net asset value, there could be opportunity there to save on taxes, and that's really where the Roth conversion comes into play. So let's look at what that might, really be in a real life scenario. And let's say we've got an alternative asset, and the net asset value is $100,000. QA in this slide stands for qualified appraiser, and what that means is how do you determine fair market value if a particular asset does not trade on the exchange like a closed-end fund, and there isn't an opportunity, or there isn't an opportunity to look up a price on any given point in the day. How do you find out what a willing buyer and a willing seller would agree to? Well, the answer is you've got to get an appraisal. So QA stands for qualified appraiser, or appraisal, either or. So you take the adjustment. In this case, we're going to assume a 35% adjustment. So the appraiser looked at this particular asset, and they took into account all the different factors we talked about, things like it's not traded, you can't easily convert it to cash. What would a willing buyer actually offer? What would a willing seller really have to agree to make a transaction happen? And via their process, they determined that the adjustment should be 35%. So now we have a fair market value of $65,000. So there's no loss. The client, the investor, the IRA, whatever, didn't lose any money. They didn't lose 35% of the value. It simply means that for tax reporting purposes, the fair market value of this asset is $65,000, even though they still have an underlying $100,000 of net value inside that fund. And if the fund were to cash out tomorrow and liquidate everything and send them a check, they'd get $100,000. But again, for tax reporting purposes, we have to use fair market value, which in this case now is $65,000. So for Roth conversions, this is important because the fair market value is the taxable income that you have to report at the time of the conversion. So let's look at what that does to the tax bill. On the left, we've got a stock and bond portfolio, and you can see that $100,000 is net asset value, and it's also fair market value because this is all publicly traded type stuff that you can get a trading price any time of the day, and net asset value is equal to fair market value in this scenario because, again, you could sell it for that exact price any time. So there's no adjustment. The income tax, we're going to use our 33% hypothetical amount from before. The income tax is about a third, $33,000. If we look at the alternative asset column, there's our $100,000 net asset value, there's our appraiser's adjustment, and our fair market value is $65,000. But look at the tax bill. It's roughly $21,000. And we're applying the same tax rate, the same 33% tax rate, but we only have to apply it to $65,000 of income rather than $100,000 because we only have to report fair market value. So that results in an almost $12,000 advantage or tax savings by having done the conversion while alternative assets were held in the account. And I'm going to highlight a couple of things from this slide. If you think about that, I'm going to, again, just round that number to about 12,000, 11,550, we'll call it 12. Think of that in terms of the original net asset value of the account, 100 grand. That's 12%. So just in tax savings, you could kind of think of it as though the account got a 12% boost or a 12% gain without ever making a dime of real investment income. In other words, the investment itself, the asset, didn't have to go up at all, and the client just made $12,000 or 12% in the form of tax savings. I mean, that's a huge return, even on an asset that didn't move in value. The other thing to look at is the effective tax rate. And you can see that it dropped it down to about 21%. And again, this is when we take the total tax paid and compare it to the net asset value of $100,000. It drops the effective rate down to 21%. Now, if you think of that in sort of broad terms, you're essentially down almost to current capital gains rates. And that's even less than some of the historic capital gains rates. And capital gains are also scheduled to go up next year. So we're talking about getting a taxable event down that should, normally be at a much higher rate. You get it down to capital gains rates, but more importantly, it's at a rate or a level where it's unlikely that client or that person, that investor, that IRA owner will ever be in a bracket close to that again. In other words, whether the rates go up or not, it's highly unlikely that absent this opportunity to use the discounted fair market value at the time of the conversion, it's unlikely that this person would ever be in a 21% tax bracket, even in retirement, even after they've stopped working and so forth. So it's a huge, huge opportunity to mitigate the tax impact of a Roth conversion. And also, now that it's in the Roth, they've locked in 21% on the original principal that went into the Roth. And, of course, they've bought the right to never pay tax on the earnings down the road in the Roth. So it's a really, really exciting and powerful way to maximize the Roth conversion, make it more attractive, and open up sort of opportunity that maybe it wasn't there before because the tax bill was going to be too high. The other thing to note is at the bottom you'll see it says recharacterizations until October 15th for conversions from 2011, and that means there's still time. In other words, right now, somebody who did a Roth conversion during 2011 can undo it. You can recharacterize it up until October 15th of this year. So if you did one before, if you did one or even if you did one earlier this year in 2012, but if you did one in 2011 or up till now in 2012, and you're looking at it going, well, wait a minute, maybe I need to go double check that value, or maybe I was thinking about allocating to alternative assets anyway, but I haven't done it yet, whatever. It may be an opportunity for you to go back, undo that transaction, and apply some of the information that we've talked about on this presentation here, and then meet the time requirement and redo the Roth conversion, taking advantage of either the segregation strategy or the valuation opportunities. So it's a very, very powerful strategy, but you got to know about it, to use it, and that's the thing is getting the message out. So Roth conversions in general, there's a significant opportunity for both, obviously, for the individual IRA owners and then any advisors that may be on the call that advise clients on these types of strategies and transactions. It's a huge opportunity for you guys as well. Just note that it does require some advanced planning work and number crunching. You've got to really sort of look at it. Although remember, it's a risk-free transaction to go ahead and do the conversion. At some point though, you've got to sit down and take the time. Okay, what's the right thing to do? Do we recharacterize? Do we leave it? And so forth. And so just be prepared in advance. Make sure that the assets in the account are the optimum assets for that Roth conversion. Make sure the valuations are up to date, and so forth. And then the last slide is how we might be able to help you further. I actually wrote a book on these topics and strategies that there's a 20% off discount code for clients and folks from Next Generation Trust. So you can use that information there, go to our website and put in the code and get a lot more detailed information and even more strategies than what we have time to do on a call. So I encourage you to take advantage of that. And with that, Jared, I will turn it back over to you.
Wonderful. Thank you so much, Joe. Does anyone have any questions out there for Joe? You can take a few minutes for that. Now, Joe, I have one that came in. So if I fund a Roth IRA with $500 and invest it and come out with $5 million, is that all tax-free?
It's actually, well, first of all, let's just remind everybody it's a really good investment. The short answer is yes, provided that the distributions are what are known as qualified distributions, but it's really not that difficult to meet the qualified distribution standard. And basically, it's the account has to have been in place for 5 tax years or more, and the owner has to be age 59 and a half or older.
All right, wonderful. Thank you so much. Any other questions? Okay, Joe. Why do clients have until October to recharacterize back to a traditional?
The rule is you can do it up until the tax filing deadline for the year that the conversion occurred. So in other words, if the conversion occurs in tax year 2012 and it's now 2013 and I'm getting my tax return ready, and so I'm having to report that transaction, that Roth conversion, it has to be reported on my tax return for the year 2012. But remember, I file that in 2013. Usually I file it by April 15th, right, of 2013. But if an individual files for an extension of time to file their return, that extension date extends the filing deadline to October 15th. So again, I'm still filing the tax return for 2012 where I have to report the transaction, the Roth conversion that happened in 2012, but the deadline, the absolute final sort of drop-dead deadline for that tax return is October 15th. So I can undo that conversion all the way up until October 15th, sort of like get it off my tax return, if you want to think of it that way.
Now, any funds will not bump up your tax bracket that you convert?
Well, if you do a conversion and you leave the conversion in place, in other words, you do not undo it, you don't do a recharacterization, then yes, the potential is there for your tax bracket to be bumped up because the value of the assets converted have to be reported as ordinary income on your tax return. So, for example, let's say you made $80,000 in salary and you converted a $100,000 IRA. Your total reported ordinary income is now going to be $180,000. So yes, it will affect your tax bracket. If you leave the conversion in place. But if you undo it, if you recharacterize them, it's gone.
I just wanted to make that clear that your tax bracket can be bumped up if you do convert and into a Roth. But again, all the assets and the earnings at that point become tax-free. Another thing with self-directed IRAs is a good number. Most of our clients have some sort of real estate-related investment. So with the market being so down, now might be the time to convert. And that's why we at Next Generation wanted to do a presentation along with Joe to make our clients aware that property values are down. If you get a fair market value, you could be converting at a lower level, at a lower amount. Now, again, you should always speak with your tax advisor or somebody who knows your financial status a little better. But again, now could potentially be the time to do that. Are there any other questions? Now, Joe, we have a question. Can someone only convert part of their traditional IRA balance partially at a time to a Roth IRA?
Yes. So you don't have to it's not an all or nothing proposition. You don't have to do a full conversion of the entire IRA. You can do a partial conversion. So let's say even if the segregation strategy, wasn't going to be used or didn't apply, and the person had a, we'll use that same example, $300,000 IRA, but they only wanted to convert $100,000 of it. They can do a partial conversion of just that amount, or just certain, they'll just pick out which assets they want to convert. And that's another way to break up a bigger conversion over multiple tax years to spread the tax bite out, over time. Because if I convert, 25% of my account in 2012 and 25% next year in 2013, and then, so on for the next 2 years, I can spread that tax bill or that tax liability out over time. But yeah, it's definitely not an all or nothing proposition. You can pick and choose and convert whatever percentage you want.
And absolutely, just to make it clear to everyone out there, you are allowed to have as many IRA accounts as you'd like. I know a misconception that sometimes I hear is that you're only allowed to have one IRA account because you're an individual. That's not true. You could always have a traditional account as well as a Roth account.
Right, and actually you can have as many Roths as you want, or as many traditionals as you want. There's no limit.
We'll just give it one more second to see if there are any other questions. All right, thank you everyone for attending. If you have any questions, you can email me, Jared, Jaredl, at nextgenerationtrust.com. Thank you so much, Joe.
Great. Thanks, Jared. Thanks for having me.
All right. Wonderful. Thank you. Take care.
Bye-bye.